If I could take you back to one decision point in the market, I would not take you back to a moment when everybody was excited. I would take you back to the moment before the excitement became obvious. I would take you back to 2023, when a small quantum stock was trading under $1 and most investors were not paying attention. If a person had put $10,000 into the right kind of situation at the right moment, that position could have become more than $200,000. Most people hear that and immediately say, of course I would have bought it, but that is not how markets work. People say they would have bought after they see the result. They do not say it when the price is under $1, the company is burning cash. The technology sounds too early, the headlines are quiet, and the whole thing looks like a strange idea instead of an obvious opportunity. That is the real lesson. The lesson is not that one stock went up. The lesson is that there are moments in markets when the future is already beginning, but most people cannot recognize it because it does not yet look respectable. I think about that as a signal from preparation. Anybody can become interested in quantum computing after a major chip company talks about it, after the charts have moved, after the headlines have changed, after the stocks have already multiplied. That is not preparation, that is reaction. Preparation is different. Preparation is studying a field when it is still confusing, when the evidence is incomplete, when the winners are not obvious, when the prices are low because the crowd has not yet formed a belief. That is where the advantage is usually created. This is why I want to walk through quantum computing carefully. Not as a hype story, not as a promise, not as a prediction that every company in the space will become a winner. That would be foolish. Most early-stage technologies produce many failures and only a small number of durable winners. But when a technology changes from something private and theoretical into something publicly investable, and when the number of public companies begins to expand quickly, you have to pay attention. 6 months ago, there were only a small number of publicly traded pure-play quantum companies. Now that universe has expanded, more names have appeared, more are coming through the IPO pipeline. That changes the decision when there are only 1 or 2 public companies. You are often forced to make a narrow bet. You are not really investing in a theme. You are making a concentrated bet on a single management team, a single architecture, a single balance sheet, and a single path to commercialization. That is a dangerous way to invest in an uncertain technology. But when the public universe expands, the problem becomes more interesting. You can begin to compare architectures. You can separate companies with real revenue from companies that are still mostly scientific promises. You can separate hardware risk from software risk. You can separate infrastructure winners from speculative pure plays. That is how a thoughtful investor starts to build a framework. In decision theory, there is an idea often described as the 37% rule. The simple version is this: before you commit to a major decision, spend the first part of the process observing. Do not rush to decide. Watch enough to understand what good looks like. Build a baseline. Then after you have that baseline, when something clearly beats what you have already seen, you can act with more confidence. That is a very good way to think about quantum investing right now. Most investors do the opposite. They see a chart moving, they hear the word quantum, they see a headline, then they buy because they are afraid that they are late. That is not a process, that is emotion wearing a suit. The first job is to look, to study, to understand the playing field. And only after you understand the playing field can you decide whether the price, the risk, and the probability make sense. There is not one way to build a quantum computer. There are several different architectures, and the important thing now is that all of the major categories are becoming investable in public markets. That matters enormously. It means the market is no longer only asking whether quantum computing can work. It is now also asking which architecture works first, which works best, which scales economically, which finds customers, and which companies can survive long enough to reach the point where the technology becomes commercially important. Those are different questions. The first major approach is superconducting technology in the pure-play public market. One important company in this group is D-Wave. Though its main approach has historically been a specific kind of superconducting quantum computing known as annealing. Annealing is not trying to solve every possible quantum problem. It is focused on optimization problems. And optimization problems are not theoretical. They exist right now. Routing a supply chain is an optimization problem. Scheduling complex resources is an optimization problem. Drug discovery can contain optimization problems. Financial risk modeling can contain optimization problems. This is why D-Wave is interesting. It is not only a dream about what quantum computing may do one day, it has customers using systems today for real categories of work. That does not mean the stock is safe. It does not mean the valuation is reasonable. It does not mean the company will automatically become a large winner. Early-stage technology companies can be right about the future and still destroy shareholders if they dilute too much, spend too much, or fail to scale commercially. But when you see revenue growing sharply and contract activity accelerating, that becomes a signal worth studying. The thing that catches my attention is not only that revenue grew significantly. It is that new bookings in a short period began to exceed what the company had generated over much longer periods before. In a young industry, acceleration can matter more than the absolute number. Small numbers growing fast are not enough by themselves, but they tell you where to look. There is another piece of the D-Wave story that many people miss. The company has been associated with annealing, but it has also moved toward gate model capability that matters because it gives the company a second path in an uncertain technology cycle. Having more than one way to win can be valuable. It does not remove risk, it does not guarantee success, but it changes the risk profile. A company with one architecture is a pure bet. A company with one architecture plus a credible second path has optionality. Optionality is valuable when the future is uncertain. The second major company to understand is IonQ. IonQ uses trapped ion technology instead of relying on superconducting circuits. Trapped ion systems use individual atoms held and controlled with electromagnetic fields. The reason trapped ion matters is precision. Trapped ion systems are often known for high fidelity, meaning they can perform operations with relatively low error compared with some other approaches. In quantum computing, error matters enormously. A quantum computer that cannot control errors does not become a useful machine. It becomes a science project with a stock ticker. IonQ is important because it has become one of the largest pure-play companies in the field by revenue and market value. It has also been building a backlog that has expanded significantly. And backlog is important because it can show that customers are willing to commit beyond one small experiment. Again, backlog is not cash in the bank. It is not the same as profits. It can be delayed, it can change, it can disappoint. But in a young field, backlog is one of the signs that the market is moving from curiosity toward demand. IonQ has also pursued a manufacturing strategy that could matter in a world where technology supply chains and national security increasingly overlap. If a company can control more of its manufacturing process, especially on US soil, that can make it more relevant for government and defense-related work. This is a pattern I watch closely. In technology cycles, the winning companies often do not only have the best technical idea, they also build the right position in the value chain. They control what matters, they reduce dependencies, they make themselves hard to replace. If IonQ can combine trapped ion precision, a growing backlog, and more control over manufacturing, then it becomes a name that belongs on the serious watch list. But serious watch list does not mean automatic buy. That distinction is important. One of the biggest mistakes individual investors make is confusing interest with action. You can be very interested in a company and still decide that the price does not compensate you for the risk. That is not hesitation. That is discipline. Then there is Rigetti. Rigetti uses superconducting gate model technology, which places it closer to the architecture that many people associate with the largest quantum efforts from major technology companies. The opportunity here is clear. If superconducting gate model systems scale, the upside could be substantial. But the risk is also clear. This is a field where the largest technology companies have enormous resources. IBM, Google, and others are not standing still. So when you look at a smaller pure-play company like Rigetti, you are asking a very specific question. Can this company move fast enough, execute well enough, and secure enough meaningful contracts to justify the risk of competing in one of the hardest engineering races in the world? That is a very different question from simply asking whether quantum computing is exciting. And with Rigetti, concentration risk matters. When a meaningful percentage of expected revenue depends on a small number of contracts, execution becomes a major variable. If deliveries slip, the story changes. If customers delay, the numbers change. If timelines move, the market can punish the stock quickly. Quantum hardware delays should not surprise anyone. This is difficult technology, but investors must price that difficulty into their expectations. A company can be promising and fragile at the same time. That is the nature of early-stage investing. Then there is Quantum Computing Inc., often traded under the CUT symbol. This is the kind of name where I believe discipline matters even more. The revenue base has been extremely small, the company has faced serious warnings, and there have been legal and credibility concerns around some of the claims made about relationships and revenue. When a company in an emerging technology field has tiny revenue and significant controversy, I do not treat it as a normal investment. I treat it as a very high-risk speculation. This does not mean the stock cannot rise. Speculative stocks can rise sharply. They can rise for reasons that have little to do with fundamentals. A short squeeze, a headline, a sudden wave of attention, or a broad rally in the sector can move these names dramatically. But a rising price does not mean the underlying risk has disappeared. The discipline is to know what you own. If a company has minimal revenue, legal overhangs, concern questions, and unclear commercial traction, then the correct mental category is not investment, it is lottery ticket speculation. That does not make it bad for every person. Some people knowingly allocate a very small amount to high-risk, high-reward situations. But you must never confuse a lottery ticket with a core holding. That mistake destroys portfolios. So those are some of the established public names, but the more interesting change is that new entrants have started to bring other quantum architectures into public markets. That is where the universe begins to broaden. One of the newer areas is neutral atom quantum computing. Neutral atom systems use atoms that are not electrically charged and arrange them in ways that can potentially scale to large numbers of qubits. The reason this matters is that scaling is one of the core bottlenecks in quantum computing. It is not enough to build a few qubits. The world needs systems that can become large, stable, and useful. Any architecture that has a plausible scaling advantage deserves attention. One of the newer public companies in this area is Inflection. What makes it interesting is not only the neutral atom architecture, it is the combination of institutional support, quantum computing exposure, and quantum sensing revenue. Quantum sensing is important because it can be commercial earlier than full-scale quantum computing. A company with sensing products may have a bridge between today and the long-term quantum computing opportunity. That bridge matters. Many early-stage hardware companies fail, not because the science is wrong, but because they run out of money before the market is ready. A secondary revenue stream can help extend the runway. It can create customer relationships. It can give the company commercial credibility while the bigger opportunity develops. Inflection has also been selected for important quantum programs by NVIDIA. That does not guarantee success. NVIDIA support is not a magic wand, but in a developing technology ecosystem, validation from an important infrastructure leader matters. It tells you that serious players are watching. The next architecture is photonic quantum computing. Photonic systems use particles of light. The engineering appeal is meaningful because photons can operate at room temperature in ways that avoid some of the cooling complexity faced by other approaches. This does not make photonics automatically superior. Every architecture has trade-offs, but room temperature operation and potential scaling advantages make it a serious path. A company to understand here is Xanadu. What makes Xanadu especially interesting is that it is not only a hardware story, it is also a software story. The company built Penalane, an open-source quantum programming framework used by a very large share of quantum developers. That matters because software adoption can become a form of ecosystem power. Hardware races are dangerous. A hardware company must win technically, manufacture well, sell effectively, and survive capital needs. Software platforms can sometimes create value across architectures. If developers use your tools regardless of which hardware wins, you can benefit from the growth of the whole field. That is a different kind of optionality. So with Xanadu, I would not look only at the photonic hardware. I would look at the software footprint too. If Penalane continues to become a standard layer for developers, then Xanadu has a second way to remain relevant. Still, early revenue means early risk. Volatility is not a surprise. In fact, volatility is the default state for a company like this. Then there is Horizon Quantum. Horizon is positioned around hardware-agnostic quantum software tools. In plain language, that means it is not trying to win by proving one architecture is best. It is trying to build tools that can work across different architectures that can be a smart position. If the field remains fragmented, when nobody knows whether superconducting trapped ion, neutral atom, photonic, or some hybrid path wins, software that helps users work across systems can become very valuable. Think of it as middleware. In early technology markets, the middleware layer can be powerful because customers do not want to make permanent choices too early. They want flexibility, they want optionality, they want tools that reduce switching costs. But again, this is still early. A good position in the value chain must eventually become revenue, and revenue must eventually become sustainable economics. A framework is not a business model by itself. It is only the start. There are also very small names in quantum security. This area matters because if powerful quantum computers eventually threaten today's encryption, then systems need protection before the threat becomes real. Post-quantum security is a real theme. Governments and corporations cannot wait until encryption breaks to begin preparing. But some of the public names in this area are extremely early. Some are pre-revenue, some are microcaps. That means the risk is very high. These names can multiply if the market gets excited, but they can also collapse if capital becomes scarce or execution disappoints. This is why I place them in a different mental bucket. They are not the same as infrastructure companies. They are not the same as the more established pure plays. They are speculative options on a future security market. Options can be valuable. They can also expire worthless. That is how you must think about them. Beyond the current public companies, several more quantum names are expected to come to market. One of the most important is Quantinuum, majority owned by Honeywell. If Quantinuum goes public at the valuations being discussed, it could become one of the largest quantum companies in the public market immediately. That would change the landscape again. It would give investors another major pure play option and likely force the market to compare the existing names more seriously. When a large new company enters a small public universe, it can create both excitement and pressure. The excitement comes from validation, the pressure comes from comparison. If a new entrant has more revenue, more credibility, stronger partnerships, or a better balance sheet, then existing companies may need to justify their valuations more clearly. There are also companies coming from Europe, including IQM from Finland and Pasquale from France, each with its own architecture and commercialization path. If they complete public listings, the investable universe becomes even broader. By the end of 2026, investors may have a very different menu than they had only a year earlier. That is the point. Quantum is moving from a small collection of speculative tickers into a more developed public ecosystem. It is still risky, it is still early, it is still full of uncertainty. But the field is becoming investable in a more structured way. That is what creates the opportunity for a thoughtful framework. Now, there is another layer that many people forget: the companies that may win no matter which quantum architecture wins. These are the infrastructure companies. Amazon Web Services, Microsoft Azure, NVIDIA, and other major platforms do not need quantum computing to succeed. They already have enormous businesses. They already generate cash flow. They already control cloud infrastructure, software ecosystems, chips, and developer relationships. But if quantum succeeds, they can become toll collectors. Amazon can host quantum hardware providers through the cloud. Microsoft can integrate quantum services into Azure. NVIDIA can provide software platforms that connect with quantum processors and support the broader computing stack. This is why infrastructure matters. In a gold rush, the most durable profits often go not to the miners, but to the people who sell the picks, shovels, roads, rails, tools, and financing. Quantum may be similar. A pure play quantum company could become a huge winner, but it could also fail. An infrastructure company can win from the theme without needing a single pure play to dominate. That is a different risk-reward profile. It is not as explosive. It is not likely to produce the same kind of 20 times result from a small base, but it is more resilient. It is attached to existing cash flow. For most investors, that matters because the problem with exciting sectors is that excitement encourages concentration, and concentration in early-stage technology is dangerous. You can be right about the theme and wrong about the company. You can be right about the company and wrong about the timing. You can be right about the timing and still lose money because dilution destroys your ownership. That is why sizing is not a detail. Sizing is the strategy. Before I talk about allocation, I want to return to the question that matters most. Are quantum stocks still at good entry points today? The honest answer is maybe. That may frustrate people who want certainty, but certainty is not available. A thoughtful investor does not pretend otherwise. If the stocks have already moved dramatically, then you cannot make the same decision that was available in 2023. The price is different, the risk is different, the crowd is different, the expectations are different. But that does not mean the opportunity is gone. Some technologies create multiple entry points. Early excitement creates the first wave, then corrections shake out the weak hands, then commercial progress creates a second wave, then profitability or real adoption creates another. The challenge is knowing whether a decline is an opportunity or a warning. That is why the look phase is so important. If you have watched the field, studied the architectures, compared revenue, reviewed balance sheets, understood dilution, and tracked contract quality, then a price decline may give you a chance to act. But if you do not have that baseline, a falling price will either scare you out or tempt you in for the wrong reason. The same is true for a rising price without a framework. A rising price becomes fear of missing out. With a framework, a rising price becomes a question: did the facts improve or did sentiment improve? Did revenue accelerate or did social media get excited? Did the company sign a real customer or did it issue a clever press release? Those distinctions matter. There is also a psychological shift happening right now. 6 months ago, the fear around quantum was simple. What if it does not work? What if the science is too early? What if these companies run out of cash? What if the commercialization timeline is too far away? That fear kept people from buying. Now the fear is different. What if quantum works and I am not in it? What if this is the next major technology wave? What if I miss the next 10-bagger or 20-bagger? That fear pushes people into buying. Notice what happened. The facts did not become certain. The risk did not disappear. The companies are still early. The cash burn is still real. Dilution is still real. Competition is still real. Only the direction of fear changed. That is a very important signal, not a buy signal, not a sell signal, a pause signal. When you feel that kind of emotional pressure, the correct move is not to rush. The correct move is to slow down and ask whether the decision is calibrated. A calibrated decision begins with probability. It asks, how much can I lose? It asks, how much can I win? It asks how much of the portfolio can tolerate failure. It asks whether the upside is asymmetric enough to justify the uncertainty. An emotional decision begins with a chart. That is the difference. Every one of these quantum pure plays faces a hard reality. They are burning cash. Many will need to issue shares. When a company issues shares, your ownership is diluted. The stock can rise, and your slice of the business can still shrink over time if dilution is heavy. This is not a small point. It is one of the main reasons early-stage hardware investing is so difficult. The science may advance, but shareholders may not capture as much value as they expect. That does not make the opportunity bad. It makes the sizing critical. If I were thinking about allocating $100 across the quantum theme, I would not put all 100 into the most exciting pure play. That is not how I would handle the risk. I would break the exposure into layers. The largest layer would be infrastructure. These are the companies with real businesses today, cash flow today, and a chance to benefit from quantum if the field develops. This layer is the anchor. It is less dramatic, but it gives the portfolio stability. If I were allocating $100, I might put around half of it into the infrastructure layer. The exact names depend on valuation and personal portfolio needs, but the category is clear: cloud chips, software platforms, and the major companies that can collect tolls across the quantum ecosystem. The next layer would be the pure play builders. These are the companies where quantum is the central business: D-Wave, IonQ, Rigetti, Inflection, Xanadu, Horizon, and others in the expanding universe. This is where the upside can be much larger. It is also where the risk is much larger. If commercialization accelerates, these names can move dramatically. If timelines disappoint or capital dries up, they can fall just as dramatically. For that reason, this layer must be meaningful enough to matter, but not so large that failure damages the whole portfolio. In a hypothetical $100 allocation, maybe $35 belongs here. That is enough to participate. It is not enough to ruin you. The final layer would be the speculative dreamers, the microcaps, the quantum security names, the companies with tiny revenue, high uncertainty, and one or two possible breakthrough paths. This is not where you put serious life savings. This is where you place very small, consciously sized options. If one works, it can matter. If it fails, it should not change your life. Maybe $15 out of 100 belongs in that category, if you have the risk tolerance. For many people, the correct number may be zero. That is not pessimism. That is risk management. You must know yourself. Some investors cannot emotionally handle speculation. They say they can when the stock is going up, then they panic when it drops 50%. If that is you, do not pretend otherwise. Build a portfolio that matches your temperament, not your fantasy version of yourself. There are also quantum ETFs for people who want a basket instead of trying to pick individual companies. That can be a reasonable approach, but it still requires research. An ETF is not automatically diversified in the way people assume. You need to understand its holdings, weights, fees, liquidity, and whether it is truly exposed to quantum or simply filled with large technology companies that have only partial exposure. A basket can reduce single company risk, but it cannot eliminate theme risk. If the whole sector sells off, the ETF sells off too. That is why an ETF is a tool, not a solution. The deeper point is this: quantum computing may become one of the most important technology cycles of the next decade. It may transform optimization, chemistry, material science, security, logistics, and eventually areas of artificial intelligence. It may also take longer than people expect. Both can be true. The market does not reward good ideas automatically. It rewards timing, execution, capital discipline, customer adoption, and durable economics. You can lose money in a great theme if you buy bad companies at bad prices with bad sizing. That is why I keep coming back to principles. Watch first. Build a baseline separate signal from noise. Do not confuse excitement with evidence. Do not confuse price movement with commercial traction. Do not confuse a 10-bagger story from the past with a guaranteed 10-bagger in the future. Respect dilution, respect cash burn, respect valuation, respect your own psychology. If you do those things, you give yourself a chance to participate intelligently in a field that most investors will either ignore until it is obvious or chase after it has already moved. The goal is not to be early for the sake of being early. Being early can be expensive. The goal is to be prepared before the crowd knows how to think. That is the woodshed. The work you do before the opportunity becomes popular is what lets you act when the opportunity becomes visible. Most people want the result without the preparation. They want the 2,000% return without the 2 years of confusion, doubt, volatility, and research that came before it. Markets do not usually pay for wanting. They pay for preparation, patience, and the ability to act rationally when other people are either asleep or emotional. So the question now is not whether quantum is exciting. The question is not whether some quantum stocks can multiply. They can. The question is whether you can approach the field with enough discipline to survive the failures and still participate in the winners. That is what separates investors from gamblers. A gambler asks which stock will explode next. An investor asks which part of the ecosystem has the best probability. Adjusted return, how much capital should be allocated, what can go wrong, and how to protect the portfolio if the answer is not clear. That is the difference. And in a field like quantum, that difference is everything, because if this becomes a major technology cycle, the opportunity may be extraordinary. But extraordinary opportunity always comes attached to extraordinary uncertainty. The right response is not fear. The right response is not blind confidence. The right response is principles. Principles are how you operate when the future is unclear. And right now, the future of quantum computing is unclear, but it is no longer invisible. The companies are public. The architectures are visible. The contracts are appearing. The infrastructure players are positioning. The IPO pipeline is growing. The ecosystem is forming. That is enough to pay attention. It is not enough to abandon discipline if you take one idea from all of this. Take this one. The next great opportunity will not arrive looking safe. If it looks safe, everybody would already own it and the return would be gone. It will arrive looking uncertain, messy, controversial, too early, and difficult to value. Your job is not to remove the uncertainty. You cannot. Your job is to understand it better than the crowd, size it intelligently, and wait for evidence. That is how you avoid being the person who says, years later, I would have bought it. The market does not pay for what you would have done. It pays for what you were prepared to do when the signal appeared.